In 2022, the United States made a decision that may be remembered as the moment the rules of the global financial system changed. They demonstrated that access to the dollar system is conditional, and in doing so, they sent a chilling message to every country on earth. Your money isn't safe. Now, those countries are quietly moving their wealth into the one asset that's hardest to freeze or seize, an asset they can hold themselves. And it's creating a new bull market that most people don't even see coming. For decades, the world ran on the simple premise: the US dollar was the safest financial asset on the planet. Nations held their savings in dollars, they traded in dollars, and they trusted those dollars would always be there. That trust was the bedrock of global finance. But what happens when that trust shatters? Right now, a quiet revolution is taking place in the vaults of central banks from Warsaw to Beijing. It's a deliberate, strategic pivot away from the system we've known for 80 years. They aren't just hedging against a recession, they're reacting to a fundamental change in the rules of the game. So how did we get here? We're going to look at the hard data showing where the smart money is moving and explain what this means for the future of money itself. This isn't just a fleeting panic. It's a slow, methodical shift with huge consequences. To get what's happening now, we have to go back to the end of World War II. In 1944, at Bretton Woods, the US dollar was crowned king, pegged to gold. Even after the US cut that tie to gold in 1971, the dollar's dominance grew. It gave America what was called an exorbitant privilege. The US could print the world's money, and the world would line up to hold it in US Treasury bonds, which were seen as the ultimate risk-free asset. For a long time, the system worked. The whole point of a country holding reserves like US dollars was safety and neutrality. Your savings were supposed to be yours, no matter what. But over the last couple of decades, that assumption started to fray, as financial sanctions became a go-to tool for US foreign policy. Then came the turning point. In February 2022, after the invasion of Ukraine, the G7 nations and their allies did something unprecedented. They moved to immobilize the Russian central bank's foreign reserves. Estimates put the total figure around $300 billion, with the majority held in the European Union. Suddenly, about half of a major G20 nation's savings were inaccessible. By late 2025, the EU was taking things a step further, deciding to use the profits generated by these frozen assets to help fund Ukraine, all while debating the future of the assets themselves. This sent a shockwave through the global system. It didn't matter what your politics were. For a central banker anywhere else, the message was terrifying. Owning an asset is not the same as controlling it. Your risk-free reserves could be neutralized overnight for political reasons. The foundational promise of the dollar system, that your money was broken. Countless countries were forced to ask themselves a new, urgent question. Are our reserves truly safe? The world didn't just notice, it started to act. The data since 2022 shows a system in the middle of a radical change. While most of us were distracted by headlines about war or inflation, the world's most powerful financial institutions, central banks, were making a much deeper, structural move. After the Russian assets were frozen, central bank gold purchases more than doubled relative to the pre-2022 average, and stayed elevated even as prices hit all-time highs. In 2022, they bought a record 1,136 tons. That tells you their motive isn't about chasing a price, it's strategic. This isn't a bet against inflation. It's insurance against a new threat, sanctions risk. And who is buying is just as revealing. It's mainly emerging market nations, especially members of the BRICS Plus bloc, like China, India, and Turkey. The National Bank of Poland has been one of the most outspoken buyers. Its governor has stated an ambition to raise gold to 20% or more of the country's reserves, calling the metal a symbol of stability that boosts credibility in turbulent times. This is a conscious move to diversify away from assets that exist under another country's laws. It's a hunt for a neutral reserve asset, one that can't be so easily weaponized. Just look at the case of Venezuela. Billions in Venezuelan gold have been stuck at the Bank of England for years, amid a complex legal battle over who is the legitimate government. Regardless of the legal merits, the signal to other countries was unmistakable. If your gold is stored in someone else's backyard, it might not be yours in a crisis. This is why there's a rush not just to buy gold, but to repatriate it, to bring the physical bars home, inside their own vaults, far from the reach of foreign courts. This brings us to the core of what's happening. This unprecedented, price-insensitive demand from central banks is arguably creating a new, structural bull market for gold. This isn't like past gold rallies that were often driven by short-term fear among everyday investors. This is different. Think of gold demand in two layers. The first is the short-term emotional flow. Headlines about a war or a banking scare cause people to pile into gold ETFs. Those flows matter, but they can reverse in a flash. The second layer is the long-term strategic repositioning. This is what we're seeing from central banks. They aren't panicking, they're planning. They're making a slow, methodical choice to permanently increase their allocation to gold, because the risk of not doing it has become too high. Their constant buying, even at record prices, creates a powerful new floor for the market. So why gold? Why not other currencies? The answer is what makes gold unique in this age of weaponized finance. First, gold isn't anyone's liability. A U.S. Treasury bond is a promise from the U.S. government to pay you back. Gold is just gold. Its value doesn't depend on any single nation's political or financial system. Second, it's politically impartial. The dollar's value is tied to U.S. policy. Gold's value isn't. And third, this is the crucial part. It can be held physically at home. By holding gold bullion in their own vaults, central banks pull their reserves out of the reach of foreign sanctions and political leverage. It's the ultimate act of financial self-preservation. This shift is part of a broader trend of de-dollarization. The dollar's share of global reserves has been falling for years, from over 70% in the early 2000s to below 60% today, a level where it has hovered for the last few years. This doesn't mean the dollar is about to collapse. Its role in global trade is still massive. But it does mean that on the margins, countries are actively looking for alternatives. And the main beneficiary of that search for a safe, neutral asset is gold. When you put it all together, a clear picture emerges. The weaponization of the dollar, sealed by the freezing of Russia's reserves, shattered the world's trust in the financial system. It proved that so-called risk-free assets were actually full of political risk. In response, central banks started a historic, multi-year rush into the one asset that sits outside any single country's control: physical gold. This is bigger than the price of a yellow metal. This is a vote of no confidence in the old system. It's the quiet construction of a new, more multipolar financial world, where nations are no longer willing to put all their security in one country's hands. Markets react to wars. Central banks plan for sanctions. And in this new game, gold is winning because it's not even on the board. This structural shift might just be one of the most important financial stories of our time. What do you think this all means for the future of the dollar? Is this the beginning of a major decline, or just a small adjustment in a still dollar-dominated world? Let me know your thoughts in the comments below.